Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning once again, and today as a part of our marathon, we will start with one of the most important chapters again, that is Consolidated Financial Statement. Now this has been tested almost every attempt, and there is no exception to it. Just that in the September 24 attempt, they didn't ask the full balance sheet, but it is a very, very important chapter as far as your examination is concerned. 14 marks is a definite question, plus another 2 to 4 marks you may get in terms of MCQ. And we should not be scared of this chapter. We should learn it in a way such that we are able to score maximum in this particular chapter. Out of 14, I'll tell you the breakup of marks and how we can score at least 10 to 12 marks easily in this particular chapter. Now, typically, when it comes to consolidation question in the examination, we will have a question like there are two companies, A, B. Balance sheet of both the companies are given with some assets, liabilities, and equity. Here also we'll have assets, liabilities, and equity. And the question would be to combine these two entities and prepare a consolidated financial statement. That is what is a requirement of the question. All right. Now, when they say prepare consolidated financial statement in examination, they want us to prepare balance sheet. This typically accounts for 3 to 4 marks. Then we will have working notes. I'll come to each one of the working notes. Working notes generally will have 4 to 5 marks. And then we'll have notes to accounts. Unless the question says prepare balance sheet without notes to accounts, we will prepare notes to accounts, and notes to accounts will have about 4 to 5 marks depending on the structure of the question. Now the best thing is, because we have stepwise marking, we can score good number in balance sheet and notes to accounts even if some of our working notes are wrong. So even if you get a question where one adjustment might be tricky, we should focus on attempting this question. Even if you want to attempt it towards the end, you should attempt this question, because here out of 3 to 4 marks, 2 to 3 marks is easily scoreable. Here also you can score 2 to 3 marks easily just by preparing the balance sheet and notes to accounts because of stepwise marking. Okay. Now, coming to the question in the examination, how we should approach this particular question on consolidation. So we have a balance sheet of two entities given in the question. First thing we need to decide what is the payment done, or what is what we call as purchase consideration, which is made by the holding company to the subsidiary company or to the owners of subsidiary company or to acquire the subsidiary company. This is the first step we need to do. Now this will be given to you in the question, so no need to worry about that. Right? Then second thing that we need to do is compute the net assets or equity plus pre-acquisition reserves. So typically what happens is, we have a holding company, we have a subsidiary company. Say for example, holding company has 75% stake in subsidiary company. Means holding company can make decisions on behalf of subsidiary company. Holding company can get subsidiary company to do certain things. So the 75% holding, whenever it is there, we say H controls S. H controls S. Now, when 75% is held by H, what about the balance 25%? This balance 25% is held by something called as minority interest. Minority interest. All right. Now, H to acquire S will make certain payment. Assume for a moment the payment is 10,000. How to do and all of that, we'll come with specific questions and we'll discuss in that. H made a payment of 10,000 to acquire, let us say, 75% of S, and the net assets on the date of acquisition, of S is say 12,000. Is how much? 12,000. So what has happened? H has 75% control over S. H paid 12,000 to acquire 75%. Sorry, H paid 10,000 to acquire 75%, and the net asset on the balance sheet is net asset on the balance sheet is 12,000. Net asset on the balance sheet is 12,000. Now, S net assets on date of acquisition is equal to 12,000. This represents 100%. This represents 100%. Whereas our share, the holding company share that we say, so S has net asset on the date of acquisition, the net asset of S is 12,000. This represents 100%. Now, how much does holding company control? Holding company has 75%, minority interest has 25%. So what do? Out of this 12,000, we say that 75% belongs to the holding company. 75% belongs to the holding company. So 12,000 multiplied by 75% when I do, we get 9,000. So as on date of acquisition, H has 9,000 worth of interest, or H has net asset worth 9,000 in S. Or we can say, if S has to liquidate, H will get 9,000. Now for this 9,000, how much did we pay? We paid 10,000. So if payment is greater than net asset, what do we get? We get something called as goodwill. We get something called as goodwill. And just a minute. And if payment is less than net asset, we get something called as capital reserve. Same concept we have learned in amalgamation also. So if we have payment which is more than net asset, means the other party is worth only let us say 12,000, out of which I have share of only 9,000, but I still paid 10,000. That 10,000 minus 9,000, this extra amount is called goodwill of 1,000. This is the most important step in your examination. This is the most important step in your examination that is dependent on first and second step. Now that is where we have to pay more time on. So what you will do? You will check the payment, you will calculate net asset or equity plus pre-acquisition reserve on the date of acquisition. That is the second thing. After you are done with this, the third step, as we did, we will calculate goodwill or capital reserve. Then after that, we'll calculate what is the balance of something called as minority interest. So typically what happens is, we said assets minus liability, net asset is equal to, in this case, 12,000. Out of this 12,000, 9,000 belongs to shareholders of holding company, or you can say it belongs to holding company. Okay. Then the balance 3,000, this balance 3,000 belongs to whom? This belongs to something called as minority interest. Means the holding company, the company which controls, it has your 9,000 of interest, and minority interest is controlling 3,000, or minority interest says, I will take 3,000. So out of the net assets, I mentioned here, out of the net assets of the subsidiary, 12,000 is out of the net asset of subsidiary of 12,000, 9,000 is owned, or 9,000 is the ownership or the net asset belonging to holding company. 3,000 is what is belonging to minority interest. So next step, we will calculate minority interest. Here we will also need to check post-acquisition reserves that will come to subsequently. Then we need to calculate something called as consolidated P&L balance plus the reserve balance. Then we need to eliminate intra-group transaction, also unrealized profit, and very important, revaluation adjustment. After this, we just need to add balance sheets of A and B to get to the consolidated financial statement. Now in this, the reason why I've noted down these 7 or 8 steps, now you might have learned it in a different way. Institute has maybe 6 steps. Your faculty would have taught you 9 steps, 7 steps. The only thing is there has to be a framework. So quickly know the payment, decide how much is the net asset on date of acquisition. This is very important. Then calculate goodwill, we'll calculate minority interest. I will come to each one of this. Then consolidated balance of P&L. This is holding plus subsidiary post acquisition. Eliminate intragroup transaction, unrealized profit, any revaluation adjustment, and add balance sheets of A and B. If you are able to do this for 3 or 4 questions comfortably, consolidation will not be a challenge. Now, when we combine the balance sheet, holding company has assets, liabilities, equity, share capital, reserves. Subsidiary company has, and here we have investment in subsidiary. Subsidiary has equity, share capital, reserves, assets. Okay. Now, how do we add the balance sheet? For assets, you will take 100% of A holding and 100% of subsidiary. Means assets will be 100% of A and B. This is subject to revaluation adjustment. So which revaluation adjustment? Revaluation adjustment as on date of acquisition. That's the first thing. Then liabilities also, this also will have some liabilities. You will take 100%. So liabilities also, you will take 100%. Okay. Then equity share capital, you will take 100% of holding plus nil from subsidiary. Subsidiaries share capital, you will not consider. Reserves, you will take 100% of holding company plus out of this reserves, we will prepare one working note called as analysis of reserves. What we will do is we'll split this between pre and post. Pre and post. Whatever is there in pre, that you will not consider. Whatever is there in post, that you will consider. So 100% of H plus post acquisition profits from S. That is only with respect to H share. So if H has 75%, we will take 75% of post acquisition profit of subsidiary. Then what about balance 25%? That balance 25% will add it to something called as minority interest. So what will happen is out of these reserves, whatever is the post acquisition, pre acquisition, the one which belongs to the minority will be added as a separate line item called minority. So you'll have minority interest. You will take whatever is the share, 25% of equity share capital plus reserves. That is what is the minority interest, right? So this reserves will split between pre and post. And again, that will split between holding and minority. That is what we will do. Then investment in subsidiary and this equity share capital and pre-acquisition reserve. So what will happen? We have investment in subsidiary. We have investment in subsidiary. This, whatever we paid, in our case, it was 10,000. This will be knocked off against equity share capital and pre-acquisition reserve. Now, equity share capital and pre-acquisition reserve is equal to your net asset. That net asset was 12,000 in our case. So what you will do, 10,000 you will not take. This investment will not come. Out of this 12,000, 9,000 will be knocked off against the investment and 1,000 will come as goodwill. So here you will have goodwill component. So what about 3,000 of minority interest? That will be added to the interest. So this is how you will combine the balance sheet. Even if you are not able to do adjustments because of shortage of time, just by combining the two balance sheets quickly, even half of the balance sheet, 2 to 3 marks you can easily score. Any questions so far? No question. Okay. Now, first step, as I told you, payment is very clear. Second step is analysis of reserve. Now, what is this analysis of reserve? Basically, if you look at the balance sheet in shareholders fund of S, you are just looking at reserves of subsidiary. So whatever reserves subsidiary has, what we need to do is we need to see what is the pre-acquisition amount and what is the post-acquisition amount. Okay. So for example, you have P&L balance, you have general reserve balance, all of this, how much is pre-acquisition and how much is post-acquisition. All right. That is one thing. Now, as far as pre-acquisition is concerned, either the question will tell you that on date of acquisition, P&L was some 1,000 reserves was some 2000, for example. They will tell you directly. In that case, what you will do? Let us say we have the total balance on date of balance sheet. This is 5,000. This is 3,000. The question itself told you that pre-acquisition reserve is 1,000 and 2,000. So it will do 1,000 here, 2,000 here. So total balance is 5,000. Out of 5,000, 1,000 is pre-acquisition. So 4,000 becomes post-acquisition. 3,000 was general reserve, 2,000 is post-acquisition, pre-acquisition, 1,000 is post-acquisition. So this 1 plus 2, 3,000, this becomes a pre-acquisition, and this 5,000 becomes post-acquisition. Now here, one tricky point where a lot of students make mistake is dividend adjustment, especially when the investment has been made during the mid of the year. So that when we do a question, I'll tell you how to handle that. For now, just understand this. 3,000, 5,000, pre-acquisition, post-acquisition. Now what you will do, what is holding companies? What is minority interest? Holding company say 75%, minority interest say 25%. So 2,250 is holding share and 750 is minority interest. Same way, out of this 5,000, 1,250 is minority interest and 3,750 is holding company. Now, once you have done this table correctly, just a moment, again, I need to charge the pencil. Once you have calculated that, holding company share in the pre-acquisition is 2,250, post-acquisition is 3,750, minority 750, and post-acquisition 1,250. What we'll do is, this component of 2,250, which is pre-acquisition profit, what we'll do, we will take it to some working note called as cost of control, basically to calculate goodwill or capital reserve, whatever is the pre-acquisition. Then whatever is the post-acquisition 3,750, this will be added to P&L. What do I mean by that? This 3,750 will be added to our consolidated reserves, and the pre-acquisition profit will be considered in determining the net assets on date of acquisition or here. Okay, so that is how you will split. Then whatever is left, this 750 and 1,250, these two, what you will do is 750 and 1,250, these two will be added to minority interest balance. Okay, so that is how we will calculate what is the pre-acquisition profit, what is the minority interest, what is the post-acquisition profit, and that we will use to compute the goodwill. This you have to do it very, very carefully. If you are lucky, they will give date of acquisition, P&L, and reserves. It is straightforward. If at all, they give mid-year acquisition, that is where we have to do certain adjustments and see how to compute that. That we will do, with the question instead of just putting it into theory. That is what we will do at analysis of reserve. Now, after we have done analysis of reserve, net asset on date of acquisition is nothing but equity share capital of subsidiary plus pre-acquisition reserve. Now, for calculation of goodwill, when we have to do, what we will do, we will see what is the H limited share in equity share capital, what is H limited share in pre-acquisition profit. Here we'll do a total. In our example, we assumed this was 9,000. Then what is the purchase consideration or payment made? That was 10,000. Because we paid more, that results in goodwill. 10,000 minus 9,000, 1,000 is goodwill. 10,000 minus 9,000, 1,000 is goodwill. With this, we'll be able to compute the goodwill. As far as minority interest is concerned, minority interest is equal to 25% of equity share capital, 25% of pre-acquisition profits, and 25% of post-acquisition profits. Pre and post. That is how we will do. Okay. Now, when it comes to consolidated reserves, we will take 100% of holding plus 75% of post from subsidiary. Right? Then there are two very critical adjustments, in fact, three actually, but one of that inter-company you can handle easily. Then what we'll do, we'll carry out some adjustments called as intercompany balances. Intercompany balances. Now, what is this intercompany balances? Let us say H Limited has to pay 10,000 to S Limited. H Limited has to pay 10,000 to S Limited. Now, in H financial statement, you will have trade payable 10,000. And in subsidiaries financial statement, you have trade receivable 10,000. Now, when we are preparing consolidated financial statement, basically we are preparing holding plus subsidiary as a family. Holding plus subsidiary as a family. Correct? Now, when we are preparing holding plus subsidiary as a family, this trade payable is holding to subsidiary. Subsidiary says, I have to receive 10,000. Now, when you prepare holding plus subsidiary as a group, will you go out and say that, the parent has to pay something to the subsidiary or children has to pay something to the parent? We will not do that. So we'll cancel out these two. 10,000, 10,000. Now here, one specific adjustment sometimes comes in terms of bills payable. They would say bills payable of subsidiary is equal to 10,000 to holding. But in holding company's book, bills receivable of holding shows only 2,000 and 8,000 has been endorsed or discounted. In that case, what do we do? Total bill payable of subsidiary is 10,000. Holding had 10,000, but holding what they did was they have only 2,000. They transferred 8,000 to some other party. So as far as the group is concerned, this 8,000 is outside the group. This 8,000 is outside the group. So what we will do? What we will do is we will take 10,000 total bills payable. Out of that, 2,000 of bills receivable that we have to pay to the holding company, we will adjust that. So net bills payable will be 10,000 minus 2,000, that is 8,000. This is 8,000 which has to be paid to outsider. So if at all there is an endorsement, if at all there is discounting with the bank, you will adjust the portion which the holding or the subsidiary has. So for examination, bills payable will be equal to balance minus bills receivable held by another party. Same way for bills receivable minus whatever is held by the or whatever is due to the other party. Balance you will still show. So in our example, 10,000 was the total balance, 2,000 is with the holding, 8,000 is still bills payable in the financial statement or in the balance sheet. That is one adjustment. Then we have an adjustment of unrealized profit. A lot of time what happens is holding company sells goods to subsidiary or subsidiary company sells to holding. Okay. Subsidiary can sell to holding, holding can sell to subsidiary. In technical terms, this is called downstream, coming from up to down, and this is called upstream. And what we are interested in is if holding sells to subsidiary, let us say cost is equal to 10,000, selling price is equal to 12,000. Now, subsidiary company would say my inventory is how much? It is 12,000. My inventory is 12,000. Subsidiary company says my inventory is 12,000. But when I am preparing holding plus subsidiary as a group, as a family, I cannot say my inventory is 12,000 because the cost of my inventory is 10,000 only. The cost of my inventory is 10,000 only. So what we say, in consolidated financial statement, inventory should be shown at 10,000 only. But as per our discussion, if you understand earlier, we take 100% of holding plus 100% of subsidiary. So here we'll have 12,000. This 12,000 cannot be shown at 12,000. We have to reduce the unrealized profit and show it at 10,000 only. Show it at 10,000 only. So what do we do with this unrealized profit? This unrealized profit will be removed from the consolidated P&L. This unrealized profit will be removed from consolidated P&L. So 12,000 minus 2,000, 10,000 will be shown, and 2,000 will be the unrealized profit, which will be removed from the consolidated P&L. All right. Now, students' confusion would be, sir, when holding sales, what is to be done? When subsidiary done, what is to be done? And should we adjust it from minority interest? Should we adjust this from minority interest? That is one more question or one more doubt. Now, what you have to understand is who booked the profit? What you have to understand? Who booked the profit? If holding booked the profit, you will reduce from reserves of holding only. If subsidiary booked the profit, means if subsidiary sold it to holding company, then you will adjust it from post-acquisition profit. Automatically, minority interest will also get adjusted. Automatically, minority interest will also get adjusted. All right. So far clear? I always get confused between pre and post, but now it is clear. Okay, very good. That is the purpose of this revision. You should get 100% clarity. Okay. Now, one last critical adjustment before we take up questions is that sometimes what happens is we carry out revaluation of assets on date of acquisition. So what do you mean by that? Say, for example, this is the subsidiary balance sheet. We have assets of 10,000. Assets of 10,000. Now, for the purpose of consolidation, or when we have acquired, H Limited has agreed that these assets will now be considered to be worth 12,000. So what H Limited is saying is that these assets going forward, or for our purpose, for consolidation purpose, for acquisition purpose, it is 12,000. S continues to show it at 10,000. We are not doing revaluation as per accounting standard 10. S will continue to show it at 10,000. What H would do is, H would say, for my purpose, for my acquisition purpose, my number is 12,000. Okay, no problem. Now, this will have two impact, and you have to remember this. Every alternate question gets this adjustment. Every alternate question, we have this adjustment, and we should not be struggling for that. Okay. First thing what happens is, I have something called as net asset on date of acquisition. On date of acquisition, I have net asset or equity share capital plus reserves. Equity share capital plus reserves. This is as per balance sheet of S. So, for example, just for argument's sake, there are some other assets, or let us say there are some liabilities of 2,000. So, net asset is 8,000. Net asset is 8,000. But what is H telling? H is saying that for my consolidation purpose, for my acquisition purpose, this is not 10,000. This you should consider at 12,000. So, my net asset will now become 10,000, 12,000 minus 2,000. This has to be adjusted. So how to adjust? See, first thing what you have to do is, when you calculate this pre-acquisition reserves, or when you calculate the goodwill component here, you have to add revaluation of assets. You need to increase. So basically what you will do, here you will add revaluation of 2,000. You will add. We'll see with the question. If you now understand the format, we'll see with the question. Here you will add revaluation of 2,000. What will happen because of that? Net asset will increase. Net asset will increase. And when net assets increases, what happens? Our goodwill value will come down. That is the first thing. That is the first thing. Okay. That is the first thing. Second thing what happens is, when we are preparing consolidated financial statement, we will not take asset at 10,000. We will take subsidiaries asset at 12,000. Subsidiary will continue to show or calculate at 10,000. But for consolidation purpose, we will say those assets are worth 12,000. Those assets are worth 12,000. That is one more thing, right? Then, because this asset are worth 12,000, I have increased the value of asset. Should my depreciation not increase? So my depreciation should increase. By what number? There are two types of again adjustment. One is mid-year acquisition and one is beginning of the year acquisition. Depreciation should be increased, or on the 2,000 I should charge extra depreciation. Let us say at 10%. So this becomes 200. In the consolidated financial statement, one adjustment is we should increase the value of asset by 2000. Second adjustment is we should charge extra depreciation on that amount, which works out to 200. So in the consolidated financial statement, in the balance sheet, asset value will go up by 2000 and accumulated depreciation will be shown at higher value by 200. So net impact is 1800. Now, because I am charging more depreciation, my P&L balance should also reflect that. So in the post-acquisition column, for this 2000, I will charge depreciation of 200, which will be split between the holding and the minority. Okay, this is one adjustment which keeps coming up in the examination. Any doubt on this? Of course, I will take a full-fledged. Now we'll now jump to questions and see how do we handle those questions in the examination. Now, when we look at some questions, what will happen is you will get that confidence of answering these questions in the examination. Okay. Now look at this question, May 24, 14 marks question. Now we'll see what are the tricky points we need to take care of, when we are handling this question and how we can score maximum marks. Okay. The balance sheet of Art and Craft Limited as on 31st March is given below. So that is what we have understood. That is what they will give us. Then you have share capital reserves, trade payables, short-term borrowings, PPE, non-current investment, inventory, trade receivables, cash and cash. Okay. This is just moved upwards. Share capital breakup has been given. Reserves breakup has been given. Short-term borrowings has been given. PPE, building and plant machinery. Non-current investment in craft at cost 4,32,000. So here you have 4,32,000. That is what? Non-current investment, art into craft. Art into craft. Now, this 432 is the first thing that I told you, how much payment has been made. This is what is relevant for our calculation purpose. This is what is relevant for our calculation purpose. Then, Art Limited acquired 3,200 ordinary shares of Craft Limited on 1st of October. This is a mid-year acquisition. When there is mid-year acquisition, we have to be extra careful in calculating the pre-acquisition and post-acquisition profits. The reserves and surplus and profit and loss account of Craft Limited showed a credit balance of 40,000 and 58,700 on 1st of April. So they have given us information on 1st of April of 23 balance. They have given us information of 31st March of 24 balance, but acquisition happened mid-year. So what we need to do is we need to calculate profit earned during this period and profit earned during this period and accordingly split between pre and post. The plant and machinery of Craft Limited, which stood at 2,50,000 on 1st of April, was considered worth 2,20,000 on the date of acquisition. Now, in the example that I gave you, there was upward revaluation. Whereas in this case, what you can see, there is a downward revaluation. There is a downward revaluation. All right. Now, when there is a downward revaluation, what will happen? We will reduce the value of PPE. Now, when we reduce the value of PPE, the other thing that happens is the depreciation part will also be reduced. If it is upward revaluation, PPE value will increase, depreciation value will increase. If there is a downward revaluation, the PPE value will be reduced and depreciation will also be reduced. Okay. Now here, if it is mid-year calculation, one more thing you have to keep in mind, don't take the difference and directly compute 5%. It will not give you the correct number. You have to do the balancing figure computation. Craft Limited deducts 1% from trade receivable as a general provision against doubtful debt. This is not followed by Art. Now, one of the requirements of Accounting Standard 21 is that if there are differences in accounting policies, we have to take the accounting policy of the holding company. We have to take the accounting policy of holding company. So who is deducting? Subsidiary is deducting, holding is not deducting. So this has to be added back. On 31st March, inventory includes goods which it had purchased from Art Limited for 1,03,500, which made a profit on 15% on cost right. This is unrealized. So 4 adjustments have been given. Okay. Now, you are required to prepare consolidated balance sheet on 31st of March of 2020. Now, how do you solve in the examination? First full page, leave it for balance sheet. The next 1.5 page or 2 pages, leave for notes to accounts. Then, After that, you can put the working notes. Now, if you want, you can put the working notes in the beginning also. It is up to you. So when I was a student, first I used to prepare the working notes, and then I used to go to the preparation of balance sheet and notes to account. But if you have been used to like, first we will prepare the balance sheet, then P&L, then we'll do the working notes, that is also fine. Both approaches are acceptable. Okay. Now you'll leave that page, and when you prepare the balance sheet, there generally, if balance sheet isn't given in your schedule format, same format you can use, no problem. Mandatory notes for share capital, reserves and surplus, compulsory. Minority interest, you will have working notes. Okay. Then trade payables, inventories, trade receivables, here in the bracket itself, we can do the working. No need to prepare a separate notes because that will take more time. You can do working like this. For PP also, mandatory notes to accounts. So these three are mandatory. And the remaining part, if there is goodwill, because here you don't have goodwill heading, so here you'll have intangible assets, that also you'll need to prepare a separate notes to. Okay, that is the format. Now, first thing, coming to working note, the question says 3,200 shares. Out of how many shares? Out of, we have shares of 4 lakhs, that is 4,000 shares. So what is the percentage? Percentage is 80%. 80% is held by art and 20% is held by what we call as minority interest. That is the first. Then in 99% of the questions, what you will get is you have to do analysis of profit. Sometimes they may say the balance sheet on date of acquisition, but I have not seen so many questions on that. So you'll have questions with equity, share capital, and reserves on the date of acquisition. That is what you need to calculate. Now, here, one very important thing, we have P&L balance of 1st of April and we have P&L balance of 31st of March. In that situation, what we will assume is whatever is the difference after adjusting for profits, that difference is profit for the year. That difference is profit for the year. And this profit has been earned equally or evenly throughout the year. What do I mean by that? Here we have 40,000 and 58,700 on 1st of April. So what you can do? Either you can prepare a ledger balance or a ledger account like P&L account you can prepare and general reserve account you can prepare, where you will say by balance brought down. P&L opening balance is 58,700. Balance carried down is 2,08,000. So the balancing figure 1,49,300 is profit earned during the period. If there is some dividend paid, dividend also will be debited to P&L. If there is some transfer to reserves, that will also be debited to P&L. And this 149,300, in this case, the difference between these two balances is the profit earned during the period. If there are no adjustments, you can do the statement format. If there are adjustments, I would suggest you to prepare P&L and general reserve account. Have opening balance. Now here opening balance is 40, closing is 40, means no movement in general reserve. There is nothing which is earned during the period or transferred during the period. But if 40 became 60, we can assume that 20 has been transferred to P&L. That 20 again you will debit to P&L and the balancing figure will be profit. That is how you will work out. Okay. If there are more adjustments between P&L and general reserve, try to prepare the P&L account in ledger format. The mistakes that you will do will actually reduce. Okay. If you try to prepare in statement format, a lot of time there can be mistakes. Now, when you prepare in the statement format, what you will do is you will take opening balance plus you will, for reserves, transferred from P&L. Then you will compare that with closing balance. Difference is post-acquisition reserves during the period. Same way, P&L, what you will do? You will take opening balance, then add profit is not given. So it will be less only, less dividend paid, less general reserve. This you will compare with closing balance. Difference will be the profit for the period. But I would prefer P&L in statement format, but I'm not asking you to do the same thing. Up to you, whether you want to prepare statement or whether you want to prepare check. Okay. Now, this profit is what? During the year profit. This profit is what? During the year profit. What are we interested in? Because it is a mid-year acquisition, we need to know how much is the profit which is earned in the first part of the year and how much is the profit which is earned in the second part of the year. All right. Now, if you see here, this 40,000 is your pre-acquisition only, and profit earned between 1st of April to 30th of September, that is also pre-acquisition. Same thing is in case of P&L as well. All right. So how much is profit earned for 6 months period? Profit earned for 6 months period is 74,650 and 74,650. Sir, how did we get this? 74,650 and 74,650 is basically 1,49,300 divided by 2. 1,49,300 divided by 2. This is pre-acquisition, this is post-acquisition. Then this opening balance of 40,000 and 58,700, opening balance as on 1st of April, that entirely is a part of pre-acquisition. That entirely is a part of pre-acquisition. That is one thing. Okay. Now, some of you may be used to doing like, here you have general reserve, here you have P&L. So what you do is, you would be doing in a particular format like, you have pre, you have post. Whatever is the opening balance of, let us say, for example, P&L. Opening balance is how much? 58,700 is anyways pre, and post acquisition, or in the current year, you can say current year. Current year also there are two components, pre and post. So current year profit is 149,300. Out of this, you would say 74,650 is pre, 74,650 is post. Okay. When it comes to general reserve, opening balance is 40,000. Entirely it is pre. Entirely it is pre. So if you are doing in this format also, it is perfectly fine. No problem at all. Okay. Then coming to adjustments. Adjustments is where we tend to miss out things. One is they have said you have 1% trade receivable deduction, and second is plant and machinery revaluation. Okay. Now 1% deduction of trade receivable provision. What is the trade receivable balance? Trade receivable balance is 168,300. This 168,300 is after deduction of 1% provision. After deduction of 1% provision means this is 99%. This is 99%. So how much will be 100%? You will simply do 168,300 divided by 99%. If you do, you will get the number. So 168,300 divided by 99%, it is 170,000. Okay. Now 170 minus this provision is 17. This provision we have to write back. This provision we have to write back. Write back means what? It will increase my profit. Now out of the 1,700, 850 is for the 6 months before acquisition, and 850 is 6 months post acquisition. So we will add back provision of 850 and 850 both in re-acquisition as well as post acquisition. Then revaluation loss, the question has told us that there is a machinery which stood at 250,000 on 1st of April. We need to know the number on 1st of October. What is this number? 250 on 1st of April. So on 1st of April, if the balance is 250,000. What is the depreciation? 10% per annum or 5%. So depreciation at 5% would be 12,500. This will be 237,500. Now this 237,500 is now considered worth 220. So value considered is 220,000. The difference is 17,500. This is revaluation loss on date of acquisition. The revaluation loss on date of acquisition has to be reduced from the pre-acquisition profit. Now in this question, two important adjustments: reversal of provision and revaluation of loss. So what if there was a revaluation of gain? You will add it to the pre-acquisition profit column here. Okay, that is one thing. Now the depreciation impact of this will be given in post-acquisition column. Depreciation impact will be given in post-acquisition column. Now please keep in mind, if it is 1st of April acquisition, directly you can take the difference and calculate the amount. But if it is mid-year acquisition, you have to see what is the depreciation charged by subsidiary. Now, depreciation charged by subsidiary is how much? Depreciation charged by subsidiary for the full year will be 25,000. Depreciation charged by subsidiary for the full year will be 25,000. Out of this 25,000, 12,500 is pre and 12,500 is post. So subsidiary charges 12,500 is as depreciation post acquisition. Now, what is the value we gave on this machinery? We said it is worth 2 lakh. How much did we consider? 2,20,000. What? 2,20,000. So our worth is 2,20,000. On this 2,20,000, what is the depreciation? On this 2,25,000, our depreciation will be 2,20,000 into 5%, right? 2,20,000 into 5%. That is what we will consider as our, depreciation for the 6 months period. Because we have acquired at 220, our 6 months period depreciation is 5%. 6 months period depreciation is 5%. So how much is this? 11,000 is the depreciation. We should charge 11,000 of depreciation. Subsidiary charged 12,500 of depreciation. Means what? Subsidiary charge extra depreciation. If subsidiary charge extra depreciation, we have to reverse that. So we will add back that 1,500 of depreciation. In which column? Post acquisition. So whenever there is revaluation, immediately next impact will be depreciation. If it is revaluation gain, you will add higher depreciation. You will do a less here. So if this is plus here, it will be minus here. If it is minus here, it will be plus. So this gives us the pre-acquisition and post-acquisition profit. Any questions so far? Any questions so far in this question? Clear? Okay. Right. So two things again I'm repeating: different accounting policies and revaluation gain or loss we have discussed. Right now, whatever is the pre-column total, we will split between holding and minority interest. Holding 125,360, minority 31,350, and here 61,600, 15,400. Now, where will it go? Please, I know all of you will be aware of it, but still a quick recap. Holding, this portion will go to cost of control or goodwill calculation. Minority interest will get added to minority interest. This will get added to minority interest. This will go to post-acquisition reserves. Right? Now, coming to cost of control, cost of investment already given. What is our share in equity share capital? 3,20,000. This you can do by doing 80% into 3,20,000. 4 lakhs also. Then capital profit, what we calculated here, or pre-acquisition profit, 125,360. It is 445,360. Now remember, if we pay more, it is goodwill. Here we have paid less, so this is capital reserve. Now, whenever this cost of control comes, immediately either go and post in the balance sheet goodwill and capital reserve. Basically, in the notes to accounts, if it is capital reserve, immediately add it in reserves and surplus so that you don't fund it. Okay. After we are done with this, next thing we need to calculate is minority interest. What do we include in minority interest? Share capital for their share, that is 20%. Capital profit from here and revenue profit from here. This is the total minority interest. Then consolidated P&L. What do we take? We will take as per balance sheet 100% of holding plus revenue profit of 61,600 of subsidiary. This 61,600 comes from here. Then there is an inventory transaction. Now, inventory transaction, first thing you have to ask, who sold? Craft Limited includes goods which purchased from Art. Who sold? Art Limited sold. So if holding company sells, you will reduce the profit from holding company. How much? 1,03,500, which is 15% on cost price. So if cost is equal to 100, if cost is 100, profit is equal to 15, selling price is 115. This 1,03,500 represents 115. We need to know what is 15. So what we will do? We will take 1,03,500 divided by 115 multiplied by 15. So 1,03,500 divided by 115 multiplied by 15, we get 13,500. This 13,500, we say that this is our unrealized profit in inventory, and that will be eliminated. When we say eliminated, there is always a two-sided impact. The impact is, first, you will remove from the inventory. Second, you will remove from the P&L. Okay, so 13,500 will remove from P&L. Whose P&L? Who has sold? Who has sold? Art has sold. So Art Limited P&L. Sir, what if subsidiary would have sold this to holding company? Then what you would have done is, in this post-acquisition column, you would have one more line item called unrealized profit on inventory, 13,500. This will split between holding company and subsidiary. This we have already done. Savings also we have already done. Now, after doing this, balance sheet is very, very easy, straightforward. We may miss out on some adjustment. So what I suggest is, for example, here, plant and machinery, there is revaluation. So here you put a small tick. Then 1% from trade receivable, there is an adjustment, you put a tick here. And inventory also, there is an adjustment. So these three adjustments, you should not miss out. See, we have done the working notes correctly. In the balance sheet, if you do not do it correctly, then it becomes a... Okay. Now, how to prepare the balance sheet? Shareholders fund, share capital, you will take 650. Reserves and surplus, we have already prepared the working note. From there, you will take the total. But you will have a notes to account for that. This you don't need to take because this is split between pre and post already. Trade payables, you will add 100%. Short-term borrowings, 100%. Non-current assets, this plus this minus the adjustment. Now, what is the adjustment? See, there was an adjustment of decrease 17,500 and depreciation impact is plus 1,500. So simple thing, minus 17,500 plus 1,500, you will do the adjustment. In the PPE, minus 17,500 plus 1,500, you will do the adjustment. If it is revaluation, positive revaluation, you will take 17,500 minus 1,500. Now this depreciation, please keep in mind, it is not only for the year. If the subsidiary was acquired 2 years back, 3 years back and all of that, it is not only for the year, it is for the number of years from the date of acquisition. So that is what you have to consider. Then non-current investment, this will not be taken. If there is any other investment, that will be taken. But investment in subsidiary will not be taken. Inventories 166 plus 205 minus unrealized profit. Trade receivable 133 plus 168. Here provision will be reversed. So you will add back provision of, I think 1,500 is what we had calculated. Cash and cash equivalent 224 plus 67 you will take directly. Okay, 24 plus 67 you will take directly in the balance sheet. Now coming to notes, as I told you, notes to accounts. This is important. Reserves and surplus. Now how we will take? General reserve, P&L and capital reserve. Capital reserve, it is as per what we have calculated in cost of control. General reserve is what? General reserve is your we have done the total, no? Somewhere. Consolidated general reserve 120. This is 100% of the holding. If there is post acquisition of subsidiary, we will have post acquisition profit of subsidiary also. Okay. So in notes to accounts, important is equity share capital compulsory. This is also mandatory. Minority interest 126. You can directly show it here. No need to add it back. You can directly show it here. This is not required for examination purpose. If you skip that also, it is okay. Current liabilities, this we have done. Trade payables, this we have done. As I told you, you can directly show it here. Inventory also, you can take art plus craft minus unrealized profit. Trade receivable, art plus craft plus provision reversed. Okay, that also can be done. And cash equivalents. Now, what is the breakup of marks? Generally, if you appear for this paper or if you have attempted this question, 3 marks is for this. Typically, half mark is for this, 1 mark is for this. So 4.5, 4.5. 0.55. Sir, why are you showing bank overdraft here? Because there in the balance sheet, we don't have bank overdraft heading. That's why we gave over 5. This is 1, 6. This is 1, 7. These two put together. 7. Then 1, 8. Plus 2, 10. Plus 1, 11. Plus 1, 12. Plus 1, 13. Plus 1, 14. Somewhere around that. Okay. Or 0.5, 0.5, something like that. Question is slightly lengthier. Earlier, we used to get the same question for 16 marks. Now they're giving for 14 marks. We have discussed earlier also that after the MCQs have been introduced, they have actually, increased the length of the question. So this is a 14 marks sure short question. If you see, right, there is no complicated adjustment and we'll be able to handle this in the examination. Okay. Is that clear? Okay. All right. So one adjustment in case of intercompany transaction is here. When on 31st of March, bills payable of 12,000 shown in S Limited balance sheet had been accepted in favor of H Limited. So here, if you see bills payable, you have holding and subsidiary. Bills payable, you have 60,000 and 14,800. Bills payable of 12,000 shown in S balance sheet had been accepted in favor of H Limited. So bills payable shown of 12,000. So what is the bills payable here? Out of 1,400, 12,000 has been shown as accepted in favor of H Limited. So H Limited has a bills receivable of 1 lakh. So from 1 lakh, you'll remove 12,000. Okay, so that is one adjustment, which is normal. But sometimes what happens is they would say out of this 12,000, for example, S has accepted 12,000, 10,000 has been endorsed in favor of creditors. So only 2,000 should be adjusted. So that is one thing you have to keep in mind. Then we'll look at this question, this particular question. We'll take a break before that and then we'll continue. So we'll resume at 11:20. Okay, so by the time my pencil also will get charged, at 11:20 we'll resume. The following balance sheets of subsidiary MNT Limited is given 17, 18, 18, 19. The first adjustment says LTC values inventory on FIFO basis, MNT uses LIFO basis, which means difference in accounting policies. Now, if there is a difference in accounting policy, what do? We bring it to the accounting policy of the holding company. Okay, so we'll have to bring it down to FIFO. To bring MNT's limited inventories in line with those of LTC, its value of inventory is required to be reduced by 5,000 at the end of 1718 and increased by 12,000 at the end of 18. Means what? For 1718, they are saying reduce it by 5,000. If I reduce closing inventory by 5,000, what will be the impact? The impact will be that the profit will also be lower by 5,000. Now, if closing inventory is lower in the current year, please understand, in the next year, opening inventory will be higher. In the next year, opening inventory will be higher. If the closing in, not higher, lower, opening inventory will be lower. If opening inventory is lower in the next year, what will happen to profit? Profit balance will increase. Okay, then. And it has to be increased by 12,000 at the end of 1819. Increased by 18,000 means what? In 1819, again, we are increasing the closing inventory. That will again increase the profit. So you have to give both the impacts. MNT Limited deducts 2% from trade receivable as a general provision against doubtful debts. Prepaid expenses in MNT include sales promotion expenditure carried forward of 25,000 in 1718, 12,500 1819, being part of initial sales promotion expense of 37,500 in 1718. Now, please understand, any prepaid expenditure or any sales promotion expenditure as per accounting standard 26, you cannot defer. So whatever is this 37,500, fully you have to write in 1718. Fully you have to write in 1718 itself, which is being written off over 3 years period. We cannot do that. We have to write it off in the year of incurring itself. So this 25,000, whatever is the prepaid expenses that you're carrying it forward, that has to be written off, and 12,500 also has to be written off. Similar nature of sales promotion expenditure has been fully written off in 1718. This is what the accounting standard also requires. Restate the balance sheet of MNT Limited as of 31st March after considering the above information for the purpose of consolidation. Now, what do we do? Simple. Revenue reserves, if you see in the question, or the total revenue reserve, you see, closing balance is 5,05,000. Now, what are the questions said? For 31st March 19, so we need to only restate the next year thing. MNT deducts 2% from trade receivable as a general provision against doubtful debt. So, trade receivable, they are saying that we will deduct how much? 2%. On what value? Trade receivable, we are doing only current year, that is 1819, 3,43,000. Now, this is after deducting 2% provision, means this represents 98%. We need to know how much is 2%. So, what we will do? 343 divided by 98 multiplied by 2. So, 343 multiplied by 2 divided by 98. 343 multiplied by 2 divided by 98. We get reserves or provision is 7,000. Provision is 7,000. Now, this provision of 7,000 is not required by the holding company. This is not required by the holding company. So, we will add back. Then, closing inventory has been increased by 12,000. So, we'll add back. Now, you may ask, sir, what about the opening inventory? See, what happened was, opening inventory of 1819 is to be reduced by 5,000. So P&L will be higher by 5,000. But in the previous period, that is 17-18, you have to reduce the inventory by 5,000, which will reduce the P&L by 5,000. So this 5,000 and 5,000 impact will be net off, and you will only consider 12,000. Then sales promotion expenditure, whatever is there as prepaid balance, 12,500 you have to fully write off. Adjusted reserve is 5,11,500. So adjusted reserves will show as 5,11,500. 5,11,500. Apart from that, what is to be done? Respective adjustments have to be done. For example, in inventories you will increase, trade receivable you will restate. That is the second adjustment. And there was a prepaid expense, right? Prepaid expenses of 65,000. From that, you will reduce. From that, you will reduce 12,500 and you will show the closing balances 52,500. Okay. Simple question, but you can score good marks, right? Let's look at this particular question. Again, a 15 marks question. White Limited acquired 2250 shares of Black Limited on 1st of October. Again, a mid-year acquisition. Summarized balance sheet of both the companies as on 31st March are given below. Shareholders fund share capital 100 each fully paid up. Reserves and surplus, profit and loss account. Current liabilities, trade payables. Amount due to White Limited is I think 30,000 in this question. Non-current assets, PPE, investments, shares in Black Limited 2250 shares. Current assets, inventories, due from Black Limited, amount receivable, and cash and cash equivalent. During the year, Black Limited fabricated a machine which is sold to White Limited for 39,000. The transaction being completed on 30th September of 21. Now, this is one thing which has happened. They have sold a machine on which date? On 30th of March of 21. They have not given cost for this. So we cannot adjust the depreciation. Had they given cost for this, for example, cost was 30,000. Then depreciation has to be adjusted. Why adjusted? Because the White Limited, which is the holding company, would have charged depreciation at a higher value. We should reduce the depreciation for this purpose. Cash in transit from Black Limited to White Limited was 6,000 on 31st March. Profit during the year was earned evenly. So cash in transit is 6,000 means what? Black has sent to White. Black says trade payable. The number is I think 30,000. When we do the solution, we'll get to the number. Trade payable due to White Limited. So amount has to be paid to White Limited. That is what they're saying. Whereas Black has sent 6,000. Now what do we do with cash in transit? For cash in transit, what we will do is we will reduce from receivable. We will reduce from receivable and show it independently as a cash in transit amount. Balance of reserves and profit and loss account on 1st of April were as follows: 30,000, 30,000, 15,000, 10,000 loss. You are required to prepare consolidated balance sheet of the group as on 31st March as per the requirement of Schedule 3 of the Companies Act of 2014. Now here, what has happened? Balance of reserves are given 15,000 and 10,000. On which date? 1st of April. When are we preparing the balance sheet? On 31st of March. When did the acquisition happen? Acquisition happened on 1st of October. Acquisition happened on 1st of October. Right? Now, if you see, we need whose Black Limited analysis. Black Limited is showing that general reserve is 30,000 and profit and loss account is 90,000. General reserve is 30 and 10,000 loss. General reserve is 30,000 and 10,000 is loss here. Now, can you tell me how much is the profit made during the year 2020? What is the profit made during 2020? What is the profit made during 2020? This is as on 1st of April of, sorry, not 2021. This is as on 1st of April of 20. This is as on 31st of March of 21. What is the profit made during the year? The profit made during the year is, don't do 90 minus 10. It is 90 minus of 10,000. 90 minus of 10,000 or 10,000 loss became 90,000 profit. So profit for the period is 1 lakh. That is how you have to calculate. Okay, that is how you have to calculate. Now that 1 lakh is for the entire period. So what we will do, 50,000 pre-acquisition, 50,000 post-acquisition. And as far as general reserve is concerned, there is no movement. Entirely it is pre-acquisition. So when it comes to pre and post acquisition, again, no need to do in two different columns. You can do in a single table itself. So what you can do is you can have pre-acquisition here and post-acquisition here. Now pre-acquisition, general reserve. Now whatever is there in general reserve, entirely it is pre-acquisition. So general reserve 30,000 pre-acquisition. Then P&L balance. P&L balance is, here it is minus 10,000, minus 10,000. So you will say minus 10,000 is pre. Then profit for 6 months, 50,000. Profit for 6 months, 50,000. That is what? That is your pre-component. That is your pre-component. So you have 70,000 of pre-acquisition profit, 70,000 of pre-acquisition profit. Are we clear how to calculate when there is a loss? Okay, great. Then what is post-acquisition? Post-acquisition general reserve, there is no balance. P&L, there is a balance of 50,000. This is post-acquisition. Then what we will do? From post-acquisition, take 75% of this. This will be added to reserves. 25% here. This will be added to minority interest. Here, this will go to cost of control. This will be added to minority interest. Now, when it comes to minority interest, we'll take their share of equity share capital and 12,500 and 17,500, you get minority interest here. Then while calculating cost of control, amount paid 2,70,000 minus 2250 shares, so much, capital reserve, so much, you have capital reserve of 7,500. This immediately post in reserves and surplus working note so that you don't forget. Now, when it comes to consolidated balance sheet, share capital only holding entity. Reserves and surplus, general reserve of holding company, P&L account of holding company, 75% post-acquisition profit and capital reserve. Then minority interest, we have already calculated. Trade payables. Trade payable is 1,15,000 plus 75,000. I'll just pull out the number. This is missing here. Just give me a moment. So due to Y limited is 30,000 here. Okay, so there is a separate number. Trade payable 1,15,000 and 75,000 and 30,000 is there. Okay, so this is 75 and there is one more number of 30,000, which is trade payable. So this 30,000 is intercompany, you will not consider. 30,000 is intercompany, you will not consider. 1,15,000 plus 75, 1,90,000 is what is the trade payable. 1,90,000. Then due from Black Limited, here we are showing 36,000. Now, out of this 36,000, 30,000 is shown as trade payable already by the other party. So you'll do minus 30,000. From trade payable, you will remove 30,000. From trade receivable, you will remove 30,000. And 6,000 is cash in transit. So what you will do, you will remove 6,000 from here and you will add 6,000 to cash in cash equivalent. That is one adjustment when there is cash in transit. So whenever there is cash in transit, what you will do is you will reduce cash in transit number from the receivable part and you will show it as a separate line item. So when it comes to cash, you will take black, white and cash in transit. Inventory, black, white total, and that is what you will. Any questions in this? Simple question. Again, you can score easily 15 out of 15. Now, whenever a difficult question comes in the examination, especially in consolidation, that is what you have to do it towards the end. Okay. This one has adjustment of dividend. This one has adjustment of dividend. On 31st March, H Limited and S Limited gave the following information: equity share capital, issued capital, general reserve, profit and loss account, credit balance, trade payables, provision for tax and other provision, plant and machinery, furniture, investment. This is the cost, inventory, trade receivable, cash in bank, sundry advances. H Limited purchased 90,000 equity shares of S on 1st of April, on which date general reserve is 1500, P&L is 633. When did we purchase? We purchased on 1st of April. When did we purchase? We purchased on 1st of April. On 14 July, S Limited declared a dividend of 20% out of pre-acquisition profit. H Limited credited the dividend received to its P&L. Now, this is a typical adjustment which comes where if it is pre-acquisition dividend, what do? We credit to investment. We credit the amount to investment account. If it is pre-acquisition, what they have done here, they have credited to P&L. We have to rectify this. Rectification means what? From this investment, you will reduce that amount, and from your P&L balance also, you have to reduce the amount. And one more thing that you have to keep in mind is this closing balance 810 that you see, you will not compare with 633 because there is some dividend paid. So that dividend part also needs to be considered. On 1st November, they issued 3 fully paid equity shares of 10 each for every 5 shares held as bonus shares out of pre-acquisition general reserve. So pre-acquisition profit, dividend paid, and also bonus is issued. Now, what is the treatment of bonus issue? As far as bonus issue is concerned, what you will do is you will add to equity share capital of subsidiary and you will reduce from pre-acquisition profit of subsidiary or pre-acquisition general reserve of subsidiary. So dividend, pre-acquisition, remove from the cost of investment of holding company and reduce from the P&L balance of the holding company if it is incorrectly done. Bonus issue, what we will do? Bonus issue, we will add it to the share capital of the subsidiary company if they have not done the adjustment, and we will reduce it from the reserves. Okay. Now, sir, what do we assume? Have they may pass that entry or not? We'll assume they have passed the entry. We'll assume they have passed the entry unless the question says that the entry is not passed. Okay. On 31st of March, the inventory of S Limited included goods purchased for 50,000 from H Limited, which had made a profit of 25%. So this is closing inventory adjustment. Trade receivable, trade payable details are given below. Prepare the consolidated sheet. Prepare the consolidated sheet. Okay. Now here, first thing, do we have profit as a date of acquisition? Yes. But out of this profit, bonus has been paid or bonus has been issued. How much? They have issued bonus of 3 for every 5 shares held as bonus shares. 3 out of 5. Means if you have 5 shares, you have to add 3 more shares and final number will be 8 shares. Now, this number in the balance sheets will assume this is post bonus. Sir, what if it is pre-bonus? If it is pre-bonus, then you will have to pass the adjustment of bonus also. You have to remove from the general reserve balance here and add it to the share capital. But this is post bonus. This represents 8 shares. This represents 8 shares. So, what is the bonus issue? Bonus issue is 2,400 divided by 8 multiplied by 3. I'm repeating once again. If I have 5 shares, I'll get 3 shares. If I have 5 shares, I will get 3 shares. Now, this 5 shares and 3 shares totally now becomes 8 shares. We need to know what is the bonus component. Sir, why do we need to know? So that from the opening reserves, we can remove that amount. From the opening reserves, we can remove that amount to calculate the amount earned during the period. Okay. So how much is that? 3. 2,400 divided by 8 multiplied by 3. Bonus issue is 900. Bonus issue is 900. Meaning to say the company has transferred 900 from general reserve to capital account. So what we will do, and what I would like to do is prepare a ledger balance or ledger account of general reserve like this. So in that, what we will take, whenever there are bonus, dividend and all, I strongly suggest you to prepare the ledger account. I strongly suggest you to prepare the ledger account. Okay. So what is the general reserve balance? 1,500. So what you will do, you will say by balance brought down 1,500. By balance brought down 1,500. Then to bonus issue, how much is the bonus issue? Bonus issue is for 900. So you will say to equity share capital 900. Okay, that is one thing. Then Sorry, general reserve 1500. Closing balance of general reserve is 690. To balance carried down 690. 1500 and this said 900 plus 690. So 90 is the balancing figure. Where will we get this balancing figure from? This has come from our P&L. Where will we get this balancing figure from? This has come from P&L. All right. This has come from P&L. Now we'll also prepare the P&L account. Opening balance 633. That is as given in the question. We have transferred 90 to general reserve. All right. We have paid dividend of 300. Very good. Balance carried down 810 from the balance sheet. So the balancing figure is 567. What is this 567? This is the profit earned during the year. This is the profit earned during the year. This is the profit earned during the year. Now, when it comes to calculation of your cost of control, calculation of cost of control. Now, when it comes to calculation of cost of control, how we will do is that first, you will take what is the opening balance? Opening balance of 1500 in general reserve and 633 in P&L. So you have pre-acquisition 1500 of general reserve and you have 633 of P&L. This is the number that is given. Now what we need to do is out of this 900 has been issued as bonus. So closing balance is opening balance remaining is 600. Out of the 633, 300 has been declared as dividend. So close balance left is 333. So 600 plus 333 is the pre-acquisition. 600 plus 333 is pre-acquisition. The same thing can be received or derived from here also. 1500 minus 900. 600 is pre-acquisition number. Then here 633 minus 300. We can say 353 is pre-acquisition. Okay, that is the pre-acquisition profits. Okay, now how much did we pay? We paid 1500 to acquire this. Out of 1500, we have received some dividend. Now, how much of dividend has been received? We would have received dividend to the extent of our share. What is our share? We have purchased 90,000 shares. Currently, here there are 2,2400. 2,40,000 shares are there. How many shares did we purchase? 90. Now on this 90, we would have received the bonus issue. We would have received the bonus. So our holding will be 90 into. Currently we have 5 shares. Now our holding will be multiplied by 8. So this will be 90 into total of 8, original of 5. If we do, we get 90,000 into 8 by 5. That works out to 1,44,000. Now this 1,44,000 is our share. That is our share, which represents 60%. Which represents 60%. Now, when we have to calculate the cost of control and goodwill, our share in the share capital is how much? Out of, I'll just erase this, slightly become more clumsy. Our share has become 1,440. That is our share capital, a share of share capital in subsidiary. Then reserves, we said 1500 minus 900, 600. So 600 into 60%, general reserve share is 360. Then 633 minus 300, 333 is the P&L balance. Out of that 80%, 60%. So 333 into 60%, if I do, I'll get 199.8. I'll get 199.8. I'm repeating once again. This is 60% of share capital. This is 60% of pre-acquisition reserve, and 198.8 is 60% of P&L balance. So what is the total? 1,440 plus 360 plus 198.8, we get 199.8 98.8, that is the total net asset, and there are no other adjustment apart from this. Goods purchase, we'll assume it is subsequent. Okay, there are no other adjustment than this. Now, out of this, for 1998.8, that is the total net asset. What is the investment? 1500. This 1500 is before dividend. So what we will do? We will say 1500 minus our dividend. How much dividend did we receive? We would have received dividend of how much? They said 20% out of pre-acquisition on 14th July. So on this 90,000, we would have received 20%. So the dividend number, if you see, is 180. So how 180? 90,000 into 10 into 20%. This we are credited to P&L. Now we will remove from the P&L. We have credited to P&L. Now we will remove from the P&L 180. This will also be removed from the investment for cost of control. So 1500 minus this, you have 12. Sorry, not 1200. 1500 minus 180. 1500 minus 180. 1500 minus 180. If I do, I get 1320. 1320. Net asset share is 1998. What I have paid is only 1320. The balance will represent my capital reserve. So capital reserve is 679.8. So if we do this, 1998.8 minus 1320, 1998.8 minus 1320. If I do, I get 678.8. 679. 333, I think 333, I did a mistake. 333 into 60%. 199.8. So this is not 198.8. This is 199.8. So this will become 1999.8. So this will become 679.8. The only complexity here is calculation of this capital reserve. Only complexity in this question is calculation of capital reserve because of multiple adjustments involved in the cost of control. So what did we do? Just to quickly recap on this. We took the P&L as given in the balance sheet, opening balance sheet. We prepared a ledger account for that. We also took the opening P&L balance. From the opening P&L balance, we removed the dividend paid out of pre-acquisition. So whatever was opening P&L balance 633, out of this pre-acquisition dividend that was paid, whatever was paid, that we have removed. That we have removed in totality. So how did we get the dividend? See, this number 2400 is post-acquisition. So we calculated how much is so not post-acquisition, that is post-bonus. How much was pre-bonus? And on that, we have calculated what is the dividend. That is 300 we have removed here. Same way from general reserve, the bonus issue we have removed. So we got opening balance of bonus, general reserve, opening balance of P&L. That is one thing what we did. Then we took equity share capital. All of this we took 60%. Compared that with the investment minus whatever dividend we have received, that is minus 180, which is 1320. The balancing figure works out to your capital reserve. Is there any doubt in this? This is one question I would want you to do before the examination also because of multiple calculations involved. So step by step, if you ask me, I'll just summarize this for you. First, P&L opening balance minus dividend paid, which is pre-acquisition. General reserve opening balance minus bonus issue. Okay, this is what will give you pre-acquisition. This you will take 60% of whatever is our share and compare with investment made minus pre-acquisition dividend. Then you will get the number of capital reserve. Now, sometimes what happens is you have opening balance of P&L, let us say 10,000. Closing balance of P&L of, let us say, 15,000. And normally we will say 5,000 is post-acquisition profit or profit for the period. But say, for example, they have made dividend paid. They have paid dividend of 3,000 from opening balance. They have paid dividend of 3,000 from opening balance. Then what happens? You would prepare a P&L and say by balance brought down 10,000 to dividend 3,000 to balance carried down 15,000. So by profit for the year 8,000. By profit for the year 8,000. And now if it is mid-year acquisition, then what do we do? If it is a mid-year acquisition, we would have normally said 8,000, 4,000 is pre and 4,000 is post. Okay. But here we have a dividend which is paid out of opening balance itself. We have a dividend which is paid out of opening balance itself. Right. So in that case, this 4,000 is your post acquisition for sure. When it comes to pre-acquisition, opening balance it is 10,000. Opening balance it is 10,000 minus dividend paid 3,000. You are left with 7,000. So 7,000 plus 4,000, 11,000 will be pre-acquisition. I'm repeating once again. If it is a mid-year acquisition, then what you will do? First, you will prepare a P&L account, calculate the profit for the period, divide it equally between the pre and post. Okay. To this pre, you cannot add fully 10,000 because out of this 10,000, 3,000 of dividend has been paid. So what you will add is 10,000 minus 3,000. You will add only 7,000 in the pre-acquisition column. So you'll have 4,000 plus 7,000, 11,000 pre-acquisition, 4,000 post-acquisition, total is 15,000. If you want to prepare in a statement format, P&L, your closing balance is 15,000. Closing balance is 15,000. As per the opening balance, what you have 10,000 in the opening balance. 10,000 in the opening balance. That is what you will do. Minus dividend of 3,000. You are left with 7,000. 7,000 will be your post part will be 8,000. Not post part, current year. Then what you will do? You will do a time adjustment of 4,000 here and you will add 4,000 here. So you'll get 11,000 and here you will get 4,000. So whenever dividends are paid out of pre-acquisition profit or opening balance, then first you will do the dividend adjustment. Then from the remaining balance, you will move half of the profit to pre-acquisition and get to this. Are we clear? Others, are we clear? Okay. So this is also done. So we have seen pre-acquisition dividends. We have seen mid-year acquisition with dividend adjustment. That is one where you revise again so that you don't make a mistake. Then we also saw a case where we have, adjustment related to revaluation. So revaluation, I'm revising once again for you. Revaluation, if it is upward revaluation, add to pre-acquisition and less depreciation from post-acquisition. In the balance sheet, you will take pre-acquisition, let us say 10,000, and here depreciation is 2,000. You will take net of 8,000. Okay, this will be adjusted to PPE. That is one we have to do. Unrealized inventory, if holding sells to subsidiary, remove from the consolidated reserves. If subsidiary sells to holding, then remove from the post-acquisition profits. Okay. Then we have this concept of minority share of losses. Now, whenever there is minority who takes share of profit, post-acquisition profit, if there is loss, then what is to be done? So what you have to do is, say for example, on date of acquisition, P&L has a balance of 10,000. Equity share capital, we have a balance of 20,000. Total is 30,000. Minority interest is 20%. So minority balance is 20% of 30,000. That is equal to 6,000. Minority balance is 6,000. Let us say in year one, there is a loss of 40,000. There is a loss of 40,000. Now, this loss of 40,000, generally what happens? You will have holding company 80%, minority interest 20%. So what would happen? Generally, they would take 32,000 of loss and minority interest would bear 8,000 of loss. Now, balance in minority itself is 6,000. How will they bear 8,000 of loss? They cannot bear. We cannot show minority as a negative balance. So what the standard requires is for minority interest, let us say opening balance was 6,000. Then share of loss. Actually, it is 8,000, but we cannot give 8,000 to minority. We can give only 6,000 to minority. So this will become 0. So what about the 2,000 loss? That 2,000 loss will be borne by holding company. So for consolidated P&L purpose, you will say in the holding entity or in the holding company, you would say minus 34,000. You will say minus 34,000. Then let us say in year 2, there is a profit of 10,000. Now, out of this profit of 10,000, typically you would say 8,000 belongs to holding company and 2,000 belongs to minority interest. But before that, what you have to see, what is the balance of minority interest absorbed by holding? Now here, out of 8,000, we gave only 6,000 to minority. Here we have a balance of 2,000. So when you get the profit first time from the minority interest share out of 2,000, first you will recover this 2,000. So minority will not get anything. What will happen? Holding will get 8,000 plus 2,000. Holding will get entire 10,000. Then subsequently, if there are any profits and all, you will continue to calculate accordingly. So for this, we have a question. Typically, I don't expect that you'll get a 15 marks question, but still, because it is there as a part of study material also. Important that you revise this question before the examination. GB Limited acquired 80% of TB Limited on 1st of April at a cost of 58 lakhs when TB had equity share capital of 50 and reserves of 464. So first thing, what is the minority interest? 20%. 20% of what? 20% of 50 and 464, 20% of these two numbers, that comes to 1092, 800. Okay. That is the opening balance. Then following information is provided. Loss, profit. You are required to calculate minority interest and cost of control at the end of each year. Cost of control, you can directly calculate. I have done 2-3 questions and you would have also practiced enough number of times. Minority interest at the date of acquisition is 1092, 800. Okay. Now, what is the first year's loss? 1450. Out of this, 80% is parent, 20% is minority. So, out of this 1450, 20% goes to minority, 80% goes to holding. So, this minus 20, 8,02,800 is the closing balance. And as far as the holding company is concerned, they will add it to their year. Then, next year it is loss of 2320. Out of this 2320, 464 goes to minority, balance goes to holding. Then next year it is loss of 29. Now our closing balance is 338. For 29 lakhs, 20% loss is 580. Can the minority take 580? Minority cannot take 580 because they don't have balance. So what will happen? If minority cannot take 580, minority can take how much? Minority can take only up to 338. Minority can take only up to 338. So out of 580, 338 can be taken by minority. Balance that is left, which is 241,200. This 241,200 is absorbed by the holding company. So what will happen is, apart from their share of 2320, whatever is the number, 241,200 will be borne by holding company. 41,200 will be borne by holding company. Subsequently, you will maintain a track. What is the minority share of losses borne by holding company? 241,200. You will keep a track of this and you will continue to maintain this. Subsequently, when there is profit, we will recover. Okay. Then the balance in minority interest is nil and holding company has taken entire 25,61,200 of loss. Not entire. 388 is taken by minority, balance is taken here. 1920, 696 is the loss. Out of this, what is their share? Minority share is 139. Do they have balance? They don't have balance. So give it to holding company. So you'll add the balance to the holding company, you get 380,400. Okay. Then in 2021, there is a profit of 1,90,000. Now what do we do? Minority has profit of 3,800. But 380,400, holding company says, wait, I have taken your past losses. First, give me this 380,400. So out of 38,000, 38,000 is adjusted against this number. So you will have 380,400 minus 38,000, balance of 342,400. Okay. Then 680 is the profit. 136 is the share. Still we have to recover 342. So entire will be given to holding. Then 1270 is there, profit. 254 is the balance. 206 we have to give to holding. So out of 254, 206 will be given to holding and 47,600 will be added to minority balance. Please practice this once again. Okay, I've explained the logic in the previous concepts also, but please practice this. It may come for MCQ. It may come from MCQ. I don't expect a full 40 marks question like this in the examination. Okay. So that is about consolidated balance sheet. Any doubt you have? Any doubt you have? Any specific question you want me to take up? Yes, you can use alternate method of presentation, whichever method suits you. No need to follow this method only. The essence is what? Every year, what is the loss which is borne by the holding and what is the cumulative balance? You follow. If you have done some other way of presentation, institute also has two different ways of presentation. Your faculty would have taught it that way. Anything is fine. That is up to you. Any specific question on consolidation where you feel stuck, you want me to take up? See, we have taken about 4 or 5 questions from the past examination paper. Now, the reason why I took past examination paper and RT is for you to get comfort that yes, if a question like that comes in the examination, we will be able to solve it. Now, if you don't have any more questions, we will pause here. Tomorrow, what we will do is we'll complete the consolidated P&L, associates, and joint venture with again a quick revision of all the adjustments that we are likely to see in the examination. Okay, adjustments that you have to be careful about: pre-acquisition dividend, mid-year acquisition, revaluation. These 3 adjustments are typically where students make mistakes. Okay. Right. So we'll continue tomorrow. Tomorrow we will have the class at 9:30. I hope you are okay. I'll put the message in the WhatsApp group also. We'll have the class at 9:30. Okay. Sure. Thank you. So before we take on to the P&L, we'll again have a quick recap of whatever we discussed, because consolidation as such is not something that 1 class or 2 class will help you. You would have done enough number of questions, and you would also be knowing on how to what are the adjustments that will be difficult for you or that has been troubling you and all of that all of you would be aware of. So now what we'll do is we'll have a quick recap. When there is a consolidated balance sheet question, you have a holding company, you have a subsidiary company. They will give you assets, liability, equity. Here also they'll give you assets, liability, equity. Here they'll give you something called as investment. Okay. Now, first thing what we have to do, we have to determine what is the purchase consideration or what is the payment made. Then after that, we need to determine what is the net asset on date of acquisition. This is nothing but equity share capital plus pre-acquisition profits or pre-acquisition reserves. Okay. Now when you have pre-acquisition profit or pre-acquisition reserve, this you will prepare by doing something called as analysis of profit. So what you will do, whatever is the reserves in subsidiary, this you will split between pre-acquisition and post-acquisition. Okay, that is the first thing. Then net asset you will take only parents share. Now when you do analysis of profit, you have pre-acquisition, you have post-acquisition, you will have holding company share, and you will have minority interest. Holding company share, let us say 80%, 80%, 20%, 20%. This holding company share, this you will take to cost of control. This 20% minority interest you will add to minority interest balance. This 80% you will add to consolidated reserves, This you will add to minority interest balance. Then we saw that there could be cases where we have questions or aspects around dividend adjustment. Now whenever dividend is given, the best way is to prepare a P&L account in T-shape format. You will take opening balance to dividend paid to closing balance, and whatever is the balancing figure, this is profit for the year. Now, if there is a mid-year acquisition, this profit for the year you will again split between, let us say, 6 months. 6 months. This 6 months will be pre. This 6 months will be post. Okay, that is what is as far as analysis of profit is concerned. Then we will calculate a minority interest balance, which is share of minority in equity share capital, then share of minority in pre plus post. Please remember, minority balance cannot be negative. If at all it reaches a negative state, you will take that loss, or that loss will be given to the parent entity or the holding company. All right. So that is one more thing which we have to be clear about. Then consolidated reserves. In consolidated reserves, you will take 100% of holding plus 80% in our example of post acquisition. That is what we will do. Okay. Then after doing this, there are some adjustments. One is intercompany balances. This you will net off only to the extent of balances appearing in the books. So if there is something, let's say, like bills are discounted or bills have been endorsed in the favor of creditors or all of that, then you will not consider. Whatever is there in the balance sheet, for example, if holding says bills receivable 10,000, subsidiary says bills payable 2,000 in respect of holding subsidiary transaction, balance 8,000, sorry, I do the ulta example. Holding says bills receivable 2,000, bills payable subsidiary says 10,000. What holding has done is 8,000 they have discounted with the bank, or 8,000 they are given to supplier. In that case, only 2,000 will be adjusted, balance 8,000 will be shown. Then we have in inventory, we have something called as unrealized profit. This you will do inventory balance on balance sheet date multiplied by, if it is gross profit, it is on sale, as profit is given on sale percentage, then you will multiply the gross profit percentage on sales. Or if it is given on cost basis, for example, if they say 20% on cost, then what you will do, 20 divided by 120, and you will calculate unrealized profit. This unrealized profit, if it is holding to subsidiary, means holding is the seller, subsidiary is the buyer, then you will eliminate from post acquisition profit. If subsidiary is the seller, holding company is the buyer, then if holding has sold, you will eliminate from reserves. I wrote ulta. Reserves of holding. If subsidiary has sold and holding has purchased, then you will eliminate from post column. Okay. Now the question you have to ask is, who made the profit? If holding made the profit, remove from holding. If subsidiary made the profit, remove from post acquisition of subsidiary. Then one final adjustment, revaluation of assets. If revaluation of assets are given, then you will increase pre-acquisition profit for gains, and you will reduce pre-acquisition profit for losses. So if there is increase, you will add. If there is decrease, you will reduce. This is on the date of acquisition. Then subsequently, if there is gain, you will charge excess depreciation in post column. If there is loss, you will reduce depreciation in post column. So if here it is plus, here it has to be minus, and this net impact will be given in the balance sheet. Okay, this is the summary of all the discussions that we had, as far as consolidations are concerned. If you are clear with this, and if you have practiced enough number of questions, it will be easy for you to handle this in the examination. Now One more thing for your revision purpose, when you're again revising this chapter, don't do all questions. So your strategy should be, for 4 chapters I am writing: financial statements, amalgamation, consolidation, and internal reconstruction. For these 4 chapters, don't do all the questions again and again. Don't do all the questions from starting till end. What you should do is do at least 3 to 4 questions only, and for remaining questions have a look at only the adjustments. Only the adjustments: financial statement, amalgamation, consolidation, internal reconstruction. Have a look at only the adjustments and see, are you able to understand and give the impact of adjustment? Okay, that is what will help you to revise. In the revision stage, you should not be doing all the questions again and again and again, because you can prepare the consolidated balance sheet or balance sheet after the amalgamation or balance sheet after the reconstruction. All of that is possible. What is important is, am I able to take care of the adjustment? Is my adjustment treatment correct or not? That is what you should be looking at. Right? Now, we'll start with consolidated P&L. Now, what is consolidated P&L? Basically, holding plus subsidiaries combined P&L. Combined P&L of holding and subsidiary. Okay. Now, when I say combined P&L, what you will do, line by line, you will, for example, sales, you will take holding plus subsidiary, you will get the total. Same way purchase, same way expenses, everything you will total. There are 2 things you need to take care of. One, the subsidiary component that you take should be post acquisition only, meaning to say only from the date of acquisition. For example, you have 1st of April, you have 31st of March, acquisition happened on 1st of October. Then you will not take full year sales for subsidiary. You will take only post acquisition sales, post acquisition expenses, everything only post acquisition. Sir, why are we not taking pre acquisition? This pre acquisition will go and form part of your cost of control calculation. So that is why you will not take pre acquisition, you will take only post acquisition. Now, sometimes the problem in these type of questions is, institute does not tell clearly whether it, what is the date of acquisition. Then you have to make an assumption. If nothing has been given, take full year. But if the date of acquisition is given, then take only post acquisition. Take only post acquisition. Okay, that's the first thing. Second, if there are any intercompany transactions, intercompany sales, purchases, interest, whatever is there, if at all there are any intercompany transaction, you will reduce or eliminate. Meaning to say, let us say holding sales is 10,000, subsidiary sales is 3,000, holding sold to subsidiary 2,000. So for the total number, what you will do, you will take 10,000 plus 3,000 minus 2,000. That is how you will do. Same adjustment you will do in case of purchases also. Same adjustment you will do in case of purchases also, or any other income or expenses. Between holding and subsidiary, whatever are the transaction, that is what you will eliminate. Once you do that, then the remaining part of the problem is not a challenge. You will be able to manage it. Okay. Any question in this so far? Any question? Okay. Now we'll look at a question. Moon Limited and its subsidiary Star Limited provided the following information for the year ended 31st March of 21. Equity share capital, finished goods inventory as in 31st March. So this is what? This is opening, this is closing. Dividend income, other non-operating income, raw material consumed, selling and distribution, production, loss and sale of investment, sale and other operating income, wages, general administrative expenses, royalty paid, depreciation, interest expense. On 1st of September of 2018, Moon Limited acquired 50,000 equity shares of rupees 100 each, fully paid up in Star Limited. So when is the acquisition? Acquisition is 1st of April of 18. 1st of September of 18. 1st of September of 18. Now tell me, how many months of revenue should we take? If the acquisition is happening on 1st of September of 18, how many months of revenue should we take? Yes? 7 months. September, October, November, December, January, February, March, 7 months. That is what we typically do in the examination. But please keep in mind, we are doing for 31st March of 21. We are not doing acquisition is when acquisition is on 1st of September of 18. So reading question becomes very, very important in the examination. If I take September and immediately calculate 7 months, it will become a problem because acquisition is on 18. We are consolidating for 21. So in this year, everything is post acquisition. There is nothing pre acquisition. Everything is post acquisition. Okay, everything is post acquisition. Star Limited paid a dividend of 10% for the year ended 31st March of 20. The dividend was correctly accounted for by Moon Limited. So Star Limited paid dividend for at 10% and the dividend was correctly accounted for. Okay. Moon Limited sold goods of 17,50,000 to Star Limited at a profit of 20% on selling price. Inventory of Star Limited includes goods of 7 lakhs received from Moon Limited. Now for this transaction, there are three adjustments actually. Moon sold goods of 17,50,000. This is included in the sales of Moon. So you will reduce from that. This is also included in the purchases of Star. From there also you will reduce. Then inventory includes 7 lakhs received from Moon. My closing inventory is overvalued. So what will I do? I will reduce the profit element from the closing inventory. So 3 adjustments will be done. Selling and distribution expenses of Star Limited include 2,12,500 paid to Moon Limited as brokerage fees. So Star Limited selling and expenses include 2,12,500 received, paid to Moon. So Moon also has shown in income. Where did Moon show in its income? Moon has showed brokerage fees as its income. Okay. So you'll reduce from selling and distribution here and income from here. Every adjustment you have to do it twice. General administrative expenses of Moon Limited include 280 paid to Star Limited as consultancy fee. So 2,80,000. Here it is consultancy income. Here it is general administrative expenses. Reduced from general administrative expenses and reduced from consultancy fees. Star used some resources of Moon and they paid 50,000 to royalty. So this also you have to reduce. Prepare consolidated statement of P&L and its subsidiary for the year ended 31st March as per Schedule 3. So what do we need to do? First, sales and other operating revenues. Sales and other operating revenues is given. Now here we have to remove intercompany sales. Then they paid some brokerage fees, then some consultancy fees and then some royalty. So these income has to be reduced. Correspondingly, those expenses also needs to be removed. So when you calculate revenue, Moon, Star, total. Intercompany sales you will reduce. Consultancy fees you will reduce. Royalty you will reduce. Brokerage you will reduce. Clear? Okay. Then Star Limited paid dividend of 10% for the year ended 31st March of 20. The dividend was correctly accounted for by Moon Limited. Who paid? Star paid. To whom? Moon. Now, normally in the standalone financial statement, where will Moon account for the dividend? Moon will account for the dividend as a part of dividend income. Now, this dividend income includes dividend received from Star Limited. So, this 1680 includes dividend received from Star Limited that we have to eliminate. So, we will take 1680, 437 total dividend income. 1680, 437, they have not deducted it, but it is incorrect. You have to say less dividend received from Star. Now, because it is not pre-acquisition dividend, acquisition happened in September 18. They paid for the year ended 31st March of 20. So this is post-acquisition dividend only. They would have included in dividend income. So from that we have to reduce. How much is our stake? Our stake is 50,000 into 100 and they paid 10%. So 50,000 into 100 is 50 lakhs. 10% of that is, oh my god, so this cannot be 50,000 into 10, 5 lakhs. This 5 lakh has to be reduced from dividend. So here when you do this adjustment, you will say minus 5 lakhs. Sir, where will be the second impact? This 5 lakhs, you will add it to the reserves of the subsidiary. See, ultimately the balance sheet will not be, mismatched, balance sheet will tally. You will reduce from income of holding, which means you are reducing the reserves of holding, and this 5 lakhs you will add to reserves of subsidiary because it is post acquisition dividend. Then other non-operating income, you can take it as it is. Then material purchased, Moon Star minus 17 lakh 50,000. Minus 17 lakh 50,000, which is intercompany sales. This has to be reduced. So 1750 here has to be reduced from 1750 here. Sales reduced, purchase reduced. Okay. Direct expenses, take as it is, you will get the total number. Then changes in inventory. Now whenever you see changes in inventory, this is basically your opening stock minus closing stock. What is the inventory? Inventory, opening inventory is 42 lakhs. Closing inventory is 8575. So there is an increase in inventory. There is an increase in inventory. So what you will do? You will say increase in inventory. You will put it as a negative number because if I'm increasing, it is actually kind of an income for me. For examination purpose, just do opening minus closing. So if you do opening minus closing here, you get this number. Opening minus closing 4375 and 752. By that number, my inventory has increased. But the inventory has a profit element which I need to reduce. So that I will reduce separately. How will I reduce? They have said 20% on selling price. So directly multiply 20% and then you will reduce it. Then employee benefit expenses, take as it is. Finance cost, take as it is. Depreciation, take as it is. Then general administrative expenses. You have consultancy fee 2,80,000, royalty 50,000, and selling and distribution adjustment 2,12,500. How will we check this? Here if you see 280, 50, 212. So when you are reducing from revenue, corresponding expenses should be reduced from the other party. So here you have reduced. Same way here you will reduce the intercompany number. So you will put the final number outside. Okay. So by plotting that, you have revenue, other income, cost of material purchased, changes in inventory after adjustment, employee benefit, finance, depreciation, other expense, total tax expense, and profit before tax, which is 1 crore 10 lakhs 10,000. Okay, any doubt here in this question? Okay, no doubt. Let's look at this one. Profit and loss accounts of A Limited and its subsidiary B Limited for the year ended 31st March are given below. You have income, increase in inventory. So this actually is not an income. You have to show it as a negative number in the expenses side, and all other expenses are given. Provision for tax, dividend paid, balance of profit. A following information is given. A sold goods of 180 to B at cost plus 25%. 1/6 of goods were still lying in inventory. So 180 lakhs, first what you will do, that 180 lakhs, first thing you will reduce from the sales. Second thing, inventory. It is cost plus 25%. So 180 into 25 by 125 into 1/6. This profit element should be reduced from changes in inventory. So when you do changes in inventory, this number, you will reduce the unrealized profit. That is one thing you have to keep in mind. That is one thing you have to keep in mind. Okay. Then cost of material, again intercompany purchases will remove. Any consultancy fees etc. received, that you will remove. Okay. Then dividend paid is 225. Dividend paid is 225. Now always be mindful that this dividend, the holding company would have accounted for somewhere in other income. Now here what they have said, it is assumed that dividend adjustment has not been done in sales and other income of A Limited. That is, dividend is not included in other income. This is not a proper assumption. Assumption has to be that dividend is included. So what we will do, our share of dividend we will remove from sales and other income. So whatever dividend that subsidiary company has paid to the holding company, that will be removed. Okay. So with this, consolidated P&L is also done, right? Very less chances. So what happens is, generally after 4 or 5 attempts, one attempt they'll simply dump in the consolidated P&L question. But for MCQs, you may expect that there would be some or the other kind of consolidated P&L also being tested. Okay. Now what we'll do is we'll start off with the next two standards on consolidation, that is Accounting Standard 23 and Accounting Standard 27.